We know how to report business gross income and deductible expenses, but now we need to match the income deductions to a particular tax period, and that determines on the accounting methods that are used. The annual period for an organization that consists of 12 months is a full tax year. Anything less is a short tax year. And a short tax year might occur when a business first starts, so it might adopt a calendar year end, but might not start until July 15th, so that is less than 12 months, so it's a short tax year for the first year only. Calendar year ends are always December 31st. Any other 12-month period end date is considered a fiscal year. So it's the last day of a month that's not December, such as August 31st, June 30th, May 31st, etc. There's also an option to choose a fiscal year that's either 52 or 53 weeks long, because it's a particular day of the week, so it might be Saturday, and it's a particular Saturday in a month. So let's say the last Saturday in January. That could be the last Saturday in a 52-week period or a 53-week period. And the reason that a company might choose the last Saturday in January for their fiscal year end is that might be the end of a busy season, and it might be a good time to tend to the accounting needs. So proprietors choose the same accounting period as their owner, the proprietor, and C corporations and individuals make that choice of an accounting period the first time they file a tax return, and that must be consistent with the accounting period they use for their books, or in other words, financial reporting. Flow-through entities are required to choose a tax year that best matches the owners, plural, owners as in possessive, period. So what if you have a partnership with some individuals and some other partnerships and they have different year ends? There are rules that determine what year end the partnership in question can choose, and that will be discussed in the partnership chapter in Business 226. Financial and tax accounting methods, you have different objectives. In financial accounting, although the business wants to look profitable, it also doesn't want to look too profitable, because if there's ever a question regarding, let's say, estimates, generally accepted accounting principles, GAAP, is slow to recognize that income, but quick to recognize losses or expenses, because it wants to be conservative in not report an overly positive financial situation to readers of the financial reports, including investors, creditors, and others. And tax accounting, on the other hand, is much less conservative, because the objective of Congress in writing the tax law is to bring in as much tax revenue as quickly as they can. So companies must choose accounting methods. There are some permissible overarching or overall methods, which include cash, accrual, and hybrid. With cash, we recognize income when received and expenses when paid. With the accrual, we recognize income when earned or received if that's earlier. Or also, if we have expenses that were incurred and not yet paid for, we can still recognize them in most cases using the accrual method. The hybrid is a mix of the two. A company or a taxpayer adopts the method with the first filed tax return. Large corporations don't have a choice, they must use accrual. If the cash method is used, the income is recognized when it's actually or constructively received. So let's say somebody has received a check in the mail and it's in the mailbox at the end of the year. Simply because they haven't grabbed that out of the mailbox doesn't mean that they don't report an income. It's constructively received. Expenses are recognized when they're paid for in cash. The pros and cons of the cash method, while there's a pro, which is that it's flexible, and another is that it's simple and relatively inexpensive to use. So if someone is a small business and they have a small accounting staff and unsophisticated accounting records, the cash method will probably work well for them. The disadvantage is it's a poor match of income and expense, because sometimes the income and expenses will be reported in varying time periods. This method can be used by taxpayers with average annual gross receipts of $25 million or less over the 3 prior tax years, except for a particular entity called the tax shelter, which is for more advanced tax studies. Accrual income. With this method, income is recognized when it's earned or received, and it requires an all events test. And what that means is the taxpayer will recognize income when everything that was required for the seller to do has been done. So that determines the right to receive the income. Also needed in order to recognize income is that the amount must be able to be determined reasonably. And income will be recognized on the earliest of these dates for tax purposes, when the service or sale is completed, when payment is actually due, and usually that would be because the service or sale has been completed, or when payment is actually received for those products or the services. Here's an example. Ben provides consulting services and he bills the customer Ace for $12,000, but Ace is disputing it, saying it shouldn't be 12, it should just be 8. So how much income should Ben recognize under the accrual method this year? And the answer is just the 8, because the 12 cannot be reasonably determined, but the 8 rather is the amount in dispute. So it may change once a dispute has been resolved, but at this point, the $12,000 cannot be reasonably estimated, so he would report 8. There is something called advance payments for goods and services, and what that is when the seller receives advance payments from the customer for providing a good or service, that taxpayer can defer recognition of the income for 1 year unless the income is recognized and earned and reported in the financial records. If it's reported in the financial statement and is part of income, then it must be reported currently in the same year for tax purposes. This does not apply to payments related to rent or interest. And what that really means then is if a landlord, for example, receives several months of rent payment in a particular tax year, even though some of it's for a future year, all of that rent received would have to be reported as income in the current year when received. The same for interest income. Here's an example of an advance payment. Ben receives advance payment from his customer of $2,400 on September 30th, and it's for 2 years. So what amount of income must he recognize when he's on the cash method or when he's on the accrual method? Well, if he's on the cash method, he received all of it this year, so all of the $2,400 has to be reported. If he uses the accrual method, he can elect to defer advances for services for 1 year. So he'd report $300 this year, which is October, November, and December's income. Next year, he'd have to report all of the rest because it can only be deferred for 1 year, even though some of what the service he's providing goes into the following year. Regarding inventories, they must generally be accounted for under the accrual method if sales of the goods constitute a material, or which means significant income producing factor. And this pertains to large companies. So if it's a small company defined by the $25 million test, then this rule doesn't apply. Cash method taxpayers can opt to use the cash method for other accounts as well besides inventory, and that makes it hybrid. So there are some UNICAP rules, which stands for Uniform Capitalization Rules. And what that states is that inventory that's either purchased or produced must be accounted for using the tax version of what's called full absorption rules, meaning all costs associated with that inventory must be capitalized, and capitalized means added to the asset value, the inventory value, instead of expensed. And that then requires that indirect costs may be allocated to inventories rather than being able to take an expense deduction in the current tax year. However, the selling, advertising, and research costs do not have to be capitalized to inventory. They can be deducted in the current tax year. The exception is for small businesses again. Those with average annual gross receipts of less than $25 million are not subject to the uniform capitalization rules. One example I can give here is that Let's say inventory cost $20,000 for a particular purchase, and it's FOB shipping, so there's $1,000 of shipping paid to get the inventory to the business location. That's $21,000. But rather than that being the only inventory cost, uniform capitalization rules require that part of the purchasing agent's payroll be assigned to that inventory because he or she may have spent some time making that purchase order, receiving the goods, checking them in, making sure that they were okay, and storing them. So overall for a year, let's say the purchasing agent's payroll, the gross was $40,000. Rather than being able to expense the entire $40,000 as wages expense in a particular year, if that employee, let's say, had half of that person's time devoted strictly to inventory purchasing and everything that goes along with it, then half of the wages expense would not be expensed in the current year. It would be added to the inventory cost and would not be expensed until it's sold, which then would be part of cost of goods sold. We'll end right here and start the third video afterwards.